You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive, where we unpack the complex forces shaping our world. Today, we're taking a deep dive into a comprehensive briefing. It's titled Global Markets, Trade, Currencies, Commodities, and Geopolitics. Our mission is really to pull out the key nuggets here, help you quickly understand this intricate feedback loop between all these areas. We want to see not just what's happening, but how global markets are actively shaping geopolitics and, what that means for all of us. Okay, let's get into it.
It's absolutely true. The briefing makes it crystal clear just how interconnected everything is. These domains might seem separate, but they're not, like a sudden shift in trade policy. That can send immediate ripples through currency markets,
right,
which then hits commodity prices. And very often the driver behind it all is, geopolitics. We'll explore those connections, show you how everything from a tense trade talk to, say, a challenge to a central bank's independence can echo far and wide.
Okay, let's start with trade then. It's always high stakes. The briefing immediately points to President Trump's assertive stance, threatening substantial new tariffs again. What kind of tariffs are we looking at here, and what's the strategy this time around?
Well, the president has threatened some pretty significant new tariffs. They're specifically aimed at countries that maintain digital taxes.
The digital taxes.
Exactly. Or enforce rules seen as discriminatory against U.S. tech firms.
Yeah.
So this isn't just your old school trade dispute about, steel or something. It's a direct challenge over the digital economy. It's really a fight over data sovereignty, the future of tech. And he's also mentioned restricting exports of critical tech, chips, for example. That could fundamentally redraw global supply chains. A key insight here, I think, is that for global powers, controlling data and tech advantage, that's becoming as vital as controlling oil was, maybe. It creates totally new flashpoints in what we call trade.
So a new kind of trade war, almost, centered on technology. But it's not all a confrontation, is it? The briefing also mentions diplomatic efforts. What's happening with the U.S.-China trade talks this week?
Yeah, exactly. Even with the tough talk, there's clearly an ongoing effort to manage this, incredibly complex economic relationship. You can't just switch it off. So Chinese negotiator Li Shenggang is heading to Washington this week. He's meeting with U.S. Trade Rep Greer and Treasury officials.
Okay.
And interestingly, a U.S. spokesperson specifically welcomed China's efforts to narrow its trade surplus. The persistent one.
Right. That's been a long-standing issue.
It has. So this signals maybe a pragmatic approach.
Yeah.
Dealing with these long-term problems like trade imbalances, even while other tensions are bubbling away, it suggests neither side wants a complete economic break. It's a very delicate balance.
Okay. And beyond the U.S. and China, the briefing shows a lot of other activity, other nations engaging on trade. What do all these different developments tell us? You've got commodity exemptions, regional talks.
It paints a picture of global trade becoming much more fragmented, I think. More targeted deals, often bilateral. We seem to be moving away from that big, uniform multilateral system.
Like specific examples?
Sure. South Korea's President Lee met with President Trump. They discussed shipbuilding, nuclear energy, defense cooperation. Trade details are still pending, but it's broad. Then you have Canada and the U.S. set to meet after Ottawa rolled back some tariffs. That points towards de-escalation, maybe.
Okay.
Brazil confirmed Mercosur and Canada are resuming free trade talks in October. So regional blocs are still trying to expand ties, too. And in Southeast Asia, Indonesia announced a U.S. agreement in principle, mind you, to exempt things like palm oil, cocoa, rubber from a big 19% tariff.
Wow, that's specific.
Yes. So the big picture, nations are hedging their bets. They're building a portfolio of specific deals because the overall landscape is shifting so fast, they're not relying just on the big treaties anymore.
That's a really interesting mosaic of agreements. But just as we think things might be smoothing out, there's also potential trouble with the EU, specifically over digital services. The briefing mentions the U.S. might be considering visa sanctions on EU officials. That sounds serious.
It does, and it's a striking example of how these trade fights are now tangled up with tech policy. and even wider diplomacy. It's way beyond just goods crossing borders now.
Right.
The U.S. even thinking about visa sanctions on EU officials linked to their Digital Services Act.
Mm.
That suggests for some issues, trade policy is becoming, well, weaponized, using non-economic tools like visas to apply economic pressure. That really raises the stakes. It changes the game for international economic diplomacy.
So if you're listening, keep an eye on this. These tariffs, these agreements, these disputes, they directly influence costs, availability, everything from your phone to your food. Think about how digital services get taxed or which new trade routes open up. These aren't just abstract political moves. They really shape your daily economic life and the tech you use. Okay, moving on. This next part really highlights how incredibly sensitive global markets are to political news, almost like a hair trigger. Take the dollar index. It saw some pretty immediate volatility after a particular political announcement.
That's right, the dollar index.
Yeah.
It was mostly steady after bouncing back earlier, but it briefly slipped. Why? When President Trump posted a letter saying Federal Reserve Governor Lisa Cook had been removed.
Removed. Can he do that?
Well, Cook immediately rejected it. She insisted the president has no authority to fire her. But the declaration itself, that's a powerful challenge to the idea of central bank independence.
Huge implication.
Absolutely.
Yeah.
Markets, as that brief dollar dip showed, they crave stability. They need clear lines of authority, especially for institutions like the Fed that handle monetary policy. The immediate reaction tells you that for investors, the integrity, the independence of the Fed, that's paramount. It often outweighs other short-term political news.
That is a potent challenge to central bank autonomy. How unusual is this historically, and what are the practical effects for the Fed's ability to act, say, in a crisis beyond just that market wobble?
Direct attempts by a president to just remove a Fed governor are very rare. But the implication of such a move, even if it's legally fought, it immediately casts doubt on perceived independence.
Right, the perception matters.
Hugely. For markets, the immediate result is uncertainty. Uncertainty about future policy, about whether the Fed can resist political pressure, about the whole basis of its decisions. And that uncertainty, it can lead to capital flight or a rush into safe haven assets.
Okay. Meanwhile, other major currencies have their own stories. The euro seems to be holding up despite new political uncertainty in France. Prime Minister Bayrou calling a no-confidence vote.
Yeah, it's a fascinating contrast, isn't it? The market's clear anxiety over Fed independence in the U.S., while the euro seems pretty resilient despite this domestic political turmoil in France.
Why is that, do you think?
Well, it could suggest markets see deeper structural strengths in the eurozone. Or maybe they expect policy continuity regardless of who's in charge politically. It's hard to say for sure. In Asia, the yen got a bit firmer. That was linked to early risk aversion, basically. Investors getting nervous and moving money into safer bets like the yen when things feel uncertain globally.
Okay.
And sterling. Slightly stronger as UK markets reopened after a holiday. But, and this is important, the briefing flags that inflation pressures are still visible, especially food prices. That's a lingering worry that can drag on a currency, even if it has a good day.
And you mentioned different economic cycles. What about currencies down under, like the Australian and New Zealand dollars, the antipodeans?
They're weaker, yeah. The Reserve Bank of Australia's recent minutes didn't give them much boost. In fact, the minutes signaled more rate cuts might still be needed down the line.
So easing policy.
Exactly. It suggests they're in a different phase of their economic cycle, thinking about loosening monetary policy, which usually weakens a currency because investors look for better returns elsewhere. It just reinforces how global interest rate differences are such a powerful force driving currency movements.
And understanding these currency shifts isn't just for, big traders. It matters if you're planning a trip abroad or if your business imports or exports. A stronger dollar might make that European vacation seem cheaper, but maybe imported goods cost more. It's not abstract. It directly hits your purchasing power, your investments too, on a global scale. Okay, so from the world of finance, let's shift to the tangible stuff. Commodities. This is where every geopolitical tremor seems to find a direct echo. Oil prices, for instance. They actually felt some pressure despite the recent conflict in Ukraine. That seems counterintuitive.
It does seem that way sometimes. But oil prices are actually under a bit of pressure today, giving back some gains from Monday. The reason? Those Ukrainian strikes on Russian energy infrastructure. Well, they were dramatic, yes, but they didn't significantly disrupt global supply, apparently.
The actual supply impact.
Precisely. And Russia's energy ministry even came out saying it's working with producers to expand refining capacity. That signals they plan to maintain, maybe even boost, their market position. So the key insight here, I think, is how markets distinguish between headline shocks and real, sustained supply disruptions. The lack of a lasting impact meant prices didn't hold those gains. It maybe suggests the global energy supply chain is more resilient than we sometimes think.
Interesting. And beyond those immediate shocks, we're also seeing shifts in energy partnerships and demand patterns. What about Pakistan and Canada?
Yeah, those examples really show how fluid and adaptive these global energy markets are, constantly shifting. Pakistan, for example, asked Qatar to defer some LNG deliveries. Why? Weak domestic demand, a direct response to what's happening locally. Meanwhile, Canada's Alberta province is talking with Japan about helping finance refinery upgrades there to process Canadian heavy crude specifically. That shows new strategic partnerships forming to optimize supply chains, deal with different types of crude. The theme is this constant rerouting, renegotiating of energy strategies to meet changing demand and supply challenges all over the world.
Got it. Now let's switch to metals. Gold is apparently a standout today. Why? It's rising above $3,370 an ounce.
Gold is definitely the clear outperformer today, and its surge is directly tied back to that attempt by President Trump to oust Fed Governor Cook, the thing we talked about earlier.
Ah, the Fed independence issue again.
Exactly. That move sparked major concerns about the Fed's independence. And gold did what gold traditionally does. It acted as a safe haven asset. It reacts strongly when there are worries about political stability or the integrity of key financial institutions. It's also the mirror image of that dollar dip, reflecting that loss of institutional trust, but the reaction in gold seems much more sustained.
Right. And industrial metals. Copper is also firming up.
It is, yeah. Copper firmed up after the People's Bank of China injected more liquidity. Basically, the Chinese central bank pumped more money into their system.
What does that signal?
It boosts confidence. It signals potential increases in industrial activity, demand for materials like copper. It's a clear sign that China's economic health, especially when the central bank steps in like this, is still a massive driver for global demand in industrial metals.
Okay. And finally, the briefing mentioned some other, maybe more specific, commodity market drivers, Chile and the Shanghai Futures Exchange.
Right, just showing the sheer breadth of factors at play. In Chile, regulators brought in new rules for restarting parts of Codelco's big El Teniente copper mine after a collapse. That's regulation impacting supply. And in China, the Shanghai Futures Exchange lowered limits and margins on aluminum alloy futures. That's a financial policy tweak affecting trading conditions. It just highlights that commodity prices aren't only about simple supply and demand. They're deeply connected to government policy, safety rules, financial speculation too, all reflecting wider economic signals and how investors are feeling.
And for you listening, these commodity moves, they hit the cost of gas for your car, the price of electronics, construction materials. And when gold spikes like this, it can signal deeper worries in the financial world that might affect your investments or hint at broader inflation pressures building up globally. Okay, so let's try and bring all these threads together now. Zoom out to the geopolitical chessboard. The briefing ends with some major global flashpoints. Australia's recent strong move against Iran seems very significant.
It really is. Australian Prime Minister Albanese announced they were expelling Iran's ambassador, citing Tehran directing anti-Semitic attacks within Australia. And more than that, Canberra is formally designating Iran's Revolutionary Guard Corps, the IRGC, as a terrorist organization. This isn't just standard diplomacy. This is a nation drawing a very hard line on what it sees as state-sponsored interference on its own soil. It signals a readiness to use powerful tools that go way beyond typical diplomatic protests.
Right.
The insight here is how nations seem increasingly willing to use these strong designations with major security and diplomatic fallout to counter threats they see as domestic, even if the source is external. It sets quite a precedent.
Definitely. Now, turning to Russia and Ukraine, we still see military cooperation happening, but also some intriguing back-channel talks. President Zelensky met with U.S. envoy Keith Kellogg, discussing pressure on Moscow, expanding military cooperation. That sounds like the public track.
It is. But then, interestingly, Reuters reported that U.S. and Russian officials have quietly held energy talks on the sidelines of peace discussions.
Energy talks amidst everything.
Exactly. It highlights this complex, multi-layered reality of international relations during conflict. You have the overt military support happening in parallel with these discrete, pragmatic talks about shared interests, like energy. It's a paradox, really. It shows that even in the middle of a conflict, core national interests can sometimes create these unexpected, quiet channels for discussion.
And President Trump has also weighed in.
Yes, he said both Putin and Zelensky should meet soon. and warned of consequences if progress isn't made towards some kind of resolution. So that adds another layer of external pressure on the diplomatic side.
Okay. Finally, let's look at the Korean Peninsula. The nuclear threat there remains a critical, ongoing concern. President Lee of South Korea had some stark words, saying sanctions alone can't stop Pyongyang's nuclear buildup, and noting North Korea might already be able to make up to 20 nuclear weapons a year.
That is a stark assessment, yes. It suggests North Korea's nuclear program is accelerating, maybe faster than previously thought, and that the current strategies, like sanctions, might just not be enough.
So what's the response?
Well, in response, President Trump has been invited to APEC with the hope of setting up a meeting with Kim Jong-un. That signals a renewed push for that kind of high-level, if often unpredictable, direct diplomacy.
Back to summit diplomacy, potentially.
Potentially. Meanwhile, predictably, North Korea's military condemned the ongoing U.S.-South Korean military drills, calling them evidence of occupation plans. That's their standard framing, portraying offensive exercises as provocation. The region constantly trying to balance this accelerating nuclear threat with high-stakes, sometimes almost performative, diplomacy. It really underscores the limits of sanctions and maybe the enduring appeal, however fragile, of direct leader-to-leader talks.
So for you, listening at home, these geopolitical events show that constant interplay. Diplomacy, conflict, economic power, they all shape global stability and security. These aren't just faraway headlines. They dictate the global security climate, influence trade routes, the stability of alliances, the overall geopolitical risk that shapes investments, international cooperation, basically the world you navigate every single day. Wow. What a journey through this interconnected world. Trade, currencies, commodities, geopolitics. It's really clear, isn't it? Every thread is connected. Understanding one piece helps you see the whole intricate tapestry.
It really does. And the briefing specifically mentioned that central bank politics keep shaping sentiment and driving up volatility. Reflecting on everything we've discussed, from those tariffs driven by digital taxes to gold jumping because of worries about Fed independence, it really raises a big question for the future, I think. How might this growing politicization of traditionally independent institutions, especially central banks, how might that continue to test global financial stability? And what kind of unexpected ripple effects could that have? On everything we've touched on, global trade flows, the price of key commodities, what happens next in the coming months, the coming years?
That is a truly provocative thought to chew on. The implications are huge. We hope this deep dive has given you some valuable insights and maybe a clearer lens to view our profoundly interconnected world.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.